Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's just at the start of 2025, just in the middle of January. What I want to do in this video is to talk about the prospects for inflation in the mid and late 2020s. You may recall that at the very start of the 2020s, we had COVID, which really blew up in February and March 2020. And there was an explosion of money growth, which then, in my view, was the cause of the inflation upsurge that we had through 2021, 22, and on into early 2023. Using the same framework, what are the messages for future inflation over the next few years? You'll be aware that I always focus on the growth of money, taking the view that the rate of inflation is determined by the excess of the growth of money, broadly defined, over the trend rate of growth of output. In other words, I present, if you wish, a monetarist approach to inflation. This view was a resounding success in the early 2020s, and therefore I think it should be of interest to see what it's saying about the outlook from here. And I'm going to focus on the developed countries for most of this video. I will talk a bit about China and India at the end. And I should say just at the start that I have a surprise in terms of some of the information I give about the American banking system. So let's just look at this table here, which tries to give a synopsis of money growth trends in the last decade. It helps to understand why I was right about inflation in the early 2020s. You can see that in the 3 years to autumn 2018, money growth was low and moderate in all four of these leading economies, highest in the UK, but fairly moderate everywhere. We then had the 3 years to the third quarter of 2021, the following 3-year period, and you can see that in the USA, the compound growth rate of broad money was 12.6% a year. So that if you round it up, in fact, the increase in that 3-year period, the whole 3 years, was about 45%. And as I argued through 2020 and early 2021, this was the fundamental cause of the inflation increases that the USA suffered in that period. Money growth also picked up in the Eurozone and the UK, not very much in Japan. Inflation went up almost in all those places to double digits, or almost double digits. Then let's look on to the 3 years to autumn last year, and a total change. In the USA, the growth of money compound rate was less than 2%. In the Eurozone, it's a bit higher. In Japan, 1.5% or so, and the UK, 2%. Now then, let me just again make a critical, polemical point here, that in early 2022, I noticed this change of trend and said that inflation would come down back towards target numbers by the end of 2024, which it did in all these places. Just look at the robustness and success of this approach. So what does this tell us about the future? Well, I think the first thing to say is that money growth in the last 3 years has actually, in these countries, typically been lower, not just than in the previous 3 years, but even in the 3 years up to autumn 2018, which suggests that inflation should be moderate, very low, perhaps even maybe some periods when the price level actually falls. Just in terms of analysing the data, I just put in a couple of caveats just so we understand what's going on. First of all, there tends to be a lag between money growth and inflation. I've explained this in much of my work, but the lag varies quite a lot, but it can be typically, say, 2 years. So we can use these kind of numbers as background to thinking about 25, 26, 27, and so on. The relationship between money and inflation is very medium term in nature, rather imprecise. We also need, in thinking about these numbers, to remember that the trend rate of growth of output varies between nations. Nowadays, the trend rate of growth in Europe, the Eurozone, Japan, UK, most of these traditional advanced economies is very low, not more than 1% a year, maybe a bit higher in the USA, but not much more than 2.5% a year. And those points, nevertheless, are something of a sort of qualification to drawing two drastic conclusions about money leading to inflation. Obviously, the higher the growth of output, trend growth of output, the lower the rate of inflation for any rate of growth of the quantity of money. Okay, so that's all by way of background. I now want to look at these 4 economies in more detail, just to kind of consolidate, verify what I've just been saying. Here is the chart on the growth of money in the USA since 2009, since the Great Recession. You see very negative numbers actually back in 2010, 2009, 2010. A long period of stability, when, let me just say, there was stable growth of nominal GDP as well, and on target inflation, more or less. This money surge in 2020, particularly 2020, a bit in 2021. Then, which is crucial for our analysis today, we see this plunge in money growth. In fact, quantity of money fell for quite a bit of late 2022 and early 2023. And then a bit of a recovery in the last year or two. But with the rate of growth of money no faster than it was through most of the 2010s. Putting this in terms of just the last 3 or 4 years, you see that again, that plunge, and then rather surprisingly stable growth of money, looking at the 3-month annualized metric we're really since, about the middle of 2023. There is, in all of this, a rather important point that I want to highlight. I mean, why has this collapse in money growth occurred? Now, part of it's what the Fed has done with its assets pile. It was building that up with the asset purchases, quantitative easing in 2020 and 21, and then through late 22 and 23, it was selling off assets. That's part of the explanation for this plunge in money growth. But there's also been a rise in interest rates. And that rise in interest rates inflicted big losses on the securities holdings of the banks. Those securities holdings are mostly bonds. If the yield on bonds rises with the move in interest rates, the value goes down, and the result is a capital loss to the banks, which then hits their profits. Now, this is a chart which I think will come as a surprise. You can see it's from the Federal Deposit Insurance Corporation. The blue bits, dark blue bits of the bars show losses incurred by the American banking system. You can see they are much, much larger than in the Great Recession. There's all this hullabaloo about toxic securities. There's a lot more to say here. All I would just focus on for the moment is that the losses the American banks have incurred will damage their capital, have damaged their capital, and that will tend to restrain the growth of the US banking system in the next 2 or 3 years. The offset to that is the vast budget deficit, which is being financed to some extent from what are called money market mutual funds that have been growing very rapidly in the last couple of years, about a 15-20% annual rate, and those mutual funds are kind of money. So that's a qualification to the view that US money growth will stay down. But I think the right view is that the pressures on US inflation at present are more downwards than upwards, whatever's going on in terms of the month-by-month movement, in particular costs and prices. What about the Eurozone? Here, what I want to, this is a chart going back to 2005. Again, you see that blip in money growth in 2020, not as extreme as in the USA, but there was an upward blip. Then this collapse. And then, perhaps again, unexpectedly, you get this pickup in money growth in the last, say, 9 months, year or so, which is surprising given that interest rates have been going up in the Eurozone since 2022. I did check what had happened to the profitability of the Eurozone banking system, because the rise in interest rates in the Eurozone should again have hit the values of the bonds held by the banks. And apparently nothing of this sort has occurred in the Eurozone, which I find very puzzling, very odd. At any rate, you can see here that money growth was very low through 2022 and 2023, picking up a bit, but the last 3-month annualized figure is only about 5%. What about Japan? Accounts for 4% or so of world output, very important economy. Here too, this is a chart going back to 2005. You see this blip upwards in 2020. But it's quite important to pay some attention to the axes here. You see the top number on the left-hand axis here, the y-axis, is 18%, whereas the top number on the chart for the USA was actually around about 90%. So you can see that, in fact, although there was a blip upwards, it was much smaller in Japan, and they've had much less inflation than other countries in the 2020s so far, as indeed has been true for 30 or so years. Now, you can see the blip upwards, then again a sharp fall, and in Japan, just recently, the quantity of money has been more or less static. There's been no growth at all. Now, one reason for this is the weakness of the yen on the foreign exchanges. The Bank of Japan hasn't raised interest rates at all, barely, compared, whereas the Federal Reserve, the European Central Bank, the Bank of England, and other central banks have all raised their interest rates towards 4 or 5%. And so the yen, unsurprisingly, has been very weak. That has indeed led to some inflation in Japan, and the Bank of Japan has been intervening by selling yen and buying yen and selling foreign currencies. That the yen bought by these operations is available to finance the budget deficit. That tends to dampen down the rate of growth of money, and as you can see, money growth has actually stopped in Japan in the last year or so. Finally, the UK. This is going back to 2010. The same kind of story, stability of money growth through the 2010s, surge in 2020, led to inflation as elsewhere, comes down a little bit, and then it plunges, but revives a bit in the recent past. I think there's various things to say about the UK, but at the moment the bias of monetary policy is still towards tightness, and it's very striking, for example, that in the year to autumn 2024, the financial operations of the public sector as a whole were actually to reduce the quantity of money by about £30 billion in the year to the first quarter of 2021. They increased the quantity of money by almost £300 billion. Shows you how important policy actually is. So money growth remains low and moderate. And in the UK as well, I'd expect inflation to stay down. So we've kind of covered these economies. the message seems to me to be pretty clear. It's suggesting that the downward pressure on inflation persists. Do we need to qualify that because of what's happening in developing economies? Well, certainly not in China, where we know that the banking system is facing huge problems because of losses on real estate as the price of houses and other buildings and structures in China comes back towards levels more appropriate for the growth rate that China now has. And so you can see China's money growth falling away at the end of that chart. There's no threat to inflation in China or globally from what's happening there. India is the one place still of these economies where broad money growth is still around about in double digits, more or less. Very high trend rate of growth by current standards, over 5% a year trend growth rate of real output, perhaps even 6-7%. And so although they've got double-digit money growth, that doesn't lead to runaway inflation. It's important to the world economy, but India still has got a very closed economic system, very high tariffs and so on. And so its international importance shouldn't, I think, be overemphasized. So let's now just kind of go back to the four main developed economies. We can see that in the last 3 months, that last line in this table, that there has been, excuse me, some recovery in money growth from that 3-year period to autumn 2024, except in Japan. It's not dramatic, and indeed money growth hasn't really returned to where it was in these countries, to where it was for much of the 2010s. So my conclusion is, using this analytical framework, that inflation will stay subdued at least for the next 2 or 3 years. Of course, I don't know what's going to happen to money growth trends through this year and 2026, and one has to worry about the vast budget deficits being incurred in the USA, to some extent in Britain and Europe, also of course in Japan, and the problems of financing these deficits without causing inflation. At any rate, the Institute will follow these trends and keep you informed. Thank you.